About two-thirds of 2024 has passed, and equity funds are struggling. In the commodities market, pricing pressures peak, while bond market pricing remains competitive. Looking at market performance, macro strategies are unavoidable. This year is significant for macro strategies, with many managers delivering good results. Since Xiao Shui introduced the all-weather strategy and risk assessment, passive asset allocation models have gained popularity. Since the degree of asset diversification is inversely related to returns, leverage is crucial to meet risk assessment needs. A 6% annual return with minimal drawdown is ineffective. Thus, the main targets for domestic macro strategies are derivatives reflecting various asset volatilities, often with low or no leverage, like stock index futures and commodity futures, as well as overseas derivatives via TRS, typically controlling principal at 300 to 400%. Limited asset selection and slow timing give this strategy a strong market-driven nature. In simple terms, the more assets that rise in value, the better the performance. This year's major surges in U.S. stocks, Treasury futures, copper, and gold have provided macro strategies with significant risk-adjusted returns. The increase in the number of differentiated assets has directly boosted the short-term returns of these strategies. U.S. stocks are at all-time highs, while government bonds face central bank pressure, making recovery difficult. Gold has already been traded in anticipation, and the value of expected Fed rate cuts is diminishing. Future macro strategies may encounter short-term volatility and awkward situations. We remind investors to look beyond the surface and not be misled by short-term attractive net asset values or blindly follow the crowd.